Hi, this is Rakshadaga. If you are watching this video, that means you are interested to invest into mutual fund. Before doing that, know the basics here. This is a quick video, so I will be covering these topics. So what is mutual fund? Mutual fund is the way to invest into stocks, bonds and money market and other security. You can diversify your investment here, and mutual fund is managed by AMC, and there are some examples of AMCs. There are many other also, and all AMCs are gone by SEBI. So there are different types of mutual fund based on its risk and returns: equity, debt, balanced, hybrid and money market. So equity means your money gets invested into stocks. In debt, your amount gets invested into government bonds, securities. In balance, it is combination of equity and debt, let's say 60-40%. And money market, your money gets invested into government securities and some other stuff. uh, it is basically for short term, where you can invest for, let's say, 1 week or 1 month. You can keep it for long term also, but it is basically for short term. You can check this table for risk and returns. Now we will talk about only equity mutual funds. So in equity mutual funds there are some categories like large cap, mid cap, small cap and micro or nano cap. So in these four categories you don't get any tax benefit, and its risk and return are given in the table. In large cap, risk is less but return is also less. In mid cap, both are moderate. In small cap, risk and return are high. In micro cap, it is even higher. Now we'll talk about ELSS. It is fourth category. In this category, you get tax benefit in your income tax up to 1.5 lakh rupees per year. But in this case, your fund will be locked for 3 years from the date of investment. Its return is higher, and risk is comparatively less. So there are different type of mutual funds based on locking period: open-ended and close-ended. Open-ended means no locking period. Close-ended means there is some maturity date or something. One of the example of close-ended is ELSS. Just like I said, it has 3 years of locking period. Then these are the basic terms about mutual fund, that is NAV, entry load and exit load, and dividend. NAV is just like price of, we have price of a share. Okay, just like that, for per unit quantity of mutual fund there is some price, and that price is NAV, which is decided by AMC, and it is calculated at the end of every business day. Entry load and exit load means there are some charges applicable when you buy and sell the mutual fund. So that is nothing but entry load and exit load. And dividend is portion of company's earning which company decide to distribute between their investor. So that is dividend. You have to select uh, in which form you want your dividend. There are three options: dividend, dividend reinvestment and growth. In dividend, when you select first option, that means you get your dividend amount in the form of cash directly into your bank account. In dividend reinvestment, that amount gets reinvested in the same mutual fund plan, and number of quantity increases, like whatever amount of quantities uh, can be bought in that amount, that gets bought and added into your account. And in growth, it is similar to dividend reinvestment. Your dividend gets reinvested in the mutual fund, same mutual fund, but the thing is your quantity doesn't increase. Your NAV means its price gets adjusted. So there are benefits of each of them, and it depends person to person which one to select. You have to select it at the time of investment only. So dividend reinvestment and growth has a compounding effect, that is advantage. You don't get that advantage in dividend option. And growth is my personally I like growth option. Mutual fund plans, there are two plans. It is very important: regular plan and direct plan. Earlier there was only one plan, that is regular plan. After 2013, government has allowed us to directly invest into mutual fund without going through any third party, that is any broking firm. So in regular plan you have to pay some commission. Actually you don't pay it, it gets deducted automatically. So you have to pay to some broker firm. In the indirect plan you directly invest into AMC. So and if you go and check the returns into same mutual fund plan, one is regular and direct, one is direct, you can see that there is 0.5 to 1% difference in their returns. Okay, and believe me, it is not small difference, it is very huge difference in if you see in long terms. Mode of investment, like if you have huge amount, not huge, if you want to invest for, if you want to do one time investment, so that is lump sum. And if you want to invest in each month, automatically that amount gets deducted from your bank, and similar quantities gets mutual fund quantities gets added into your mutual fund account. So that is SIP. SIP is not any different investment plan or something, it is just a way to invest into mutual fund. And SIP has benefit of averaging. So SIP is has many benefits. That's why SIP is quite famous these days. And it is last question, that is Demat account really mandatory? No, it's not mandatory. It is one of the way to invest into mutual fund, but it is not mandatory. Now I'll show you how you can read mutual funds. So for that I'll go to money control site. It is quite famous. There are other also. Go to mutual fund. You can see there are different categories: equity, debt, hybrid, money market. And in equity there are options like large cap, then small cap and mid cap. Then there are some different many options available. Now if I click on any, you can see these are different plans. See, you can see these two are same plans. How to read it? First of all, first name is generally AMC name, second name is the whatever mutual fund plan name, it is that. Then equity means it is of equity type. Then you can see, since it is direct plan, direct is written over here, and G means growth. See, this is the same plan, these two are same plans, one is direct and one is regular. And if you check 1 year return, that is on this yellow color, it is 1 year return. If you check, it is 36.2 and this 35.7. So around 0.5 to 1% difference is there. So always go for direct plan, it is my advice. And you can check some more details. See, you can click here, you can see fund type is open ended, its option is growth, and entry load is nothing, exit load is 1%, but only if you try to sell it before 1 year. If you try to sell it after 1 year, then exit load is also 0. You can click on portfolio to check your in which shares your fund manager has invested your amount. These are the percentage in which that amount is invested. You can see full portfolio here, these are the major stocks. You can see some more details here. You can decide which fund to buy and which one should not be bought depending on their return. Generally you should check 1 year, 3 year and 5 year returns. Don't go on short term returns, these are not that much reliable. So you can check this. If history and everything is good, then you can go for those mutual funds. So that's it, these are the basics. You are watching this video on DumpBox channel. If you like the way I have explained, please click on like button. If you don't, then click on dislike button. If you have any query or doubt, put it in comment section. Share this video with your friends. And if you like this video and want some more videos like this, you can click on subscribe button. This is the quick video, and if you want similar video in depth, you can go to my channel. I'll put the link in the card also, where I explained same things but in bit detail. Okay, thank you for watching this. This is Akshay Daga.